I'm Leon Scott, and I'm working to close the wealth gap. The title of this video, How to Earn Money. Last week, created a video called What is Wealth? And one of the first components that goes into that is the top line, or your income, how you earn money. So this video is going to talk about the top 4 ways, the 4 strategies for earning money. So those 4 strategies are salary, draw, dividend income, and rental income. All right, let's get started. So salary. We're going to talk about the pros and cons of each of these different strategies. And with salary, we all are familiar with it, and that's one of the pros. We can get a job, and we know jobs exist. Now, it may be difficult to get a job, but we know that they are out there. So they're accessible, they're attainable. That's the big pro. What's the downside of salary? The downside is you get paid for your time, which puts a limit on you, or you get paid for your results, which can be fairly limitless, but those jobs that provide those salaries for results, they're quite competitive. So you have to be able to compete, and that starts off in school. Now, if you're younger watching this, there is a distinct advantage here because perhaps at a point where you don't need as much money to live because you have family that's taking care of you, you have the opportunity to volunteer, to intern, to shadow, which is great because not only do you start to create a resume with experience, you are creating relationships with people that will help you get a job so that you can get a salary. The other part of that is you can figure out what jobs you like, because part of a salary is you have to keep a job. You have to stay in that job. So if you know from years of interning as a student, from shadowing as a student, that something you thought was going to be a fun career turns out to not be what you're interested in, you can figure that out early so that when you do get started, you're likely to stay in that industry and earn an ever-increasing salary as you contribute more and more. As an adult, yes, we're a little behind the clock when it comes to starting in an industry late, but that doesn't stop us. So there will need to be interviewing. Yeah, you need to get out there and create relationships by talking to people and seeing what jobs are available and what their needs are, so you can help fulfill them for an increase in your future salary. That includes interviewing for positions at your current place of work or at new places. And networking. You have to get out and get to know people because they can open doors. And of course, you need to, or will likely need to, get more training. So back to school. Every nurse in the hospitals that I work in is looking, not every nurse, but it feels like every nurse is out to earn their nurse practitioner's license and degree. So getting back to work is another way you can increase your salary. So we're going to strategy number 2, and that's the draw. D-R-A-W, draw. The draw is the amount of pay you take from your company as an entrepreneur. So you can be an entrepreneur. The big upside here is you work for yourself and the income is limitless. Well, here comes the trade-off. Limitless based on how much your company is pulling in. You have to be able to afford your draw. So as an example, I am part of a startup team and a company that we started in November of 2020, now 5 months in, is on track to be a $1 million a year in sales company. And the growth looks like we're gonna have an opportunity to go even beyond that. So when you hear that, you're thinking, the 3 people in this startup group are probably able to draw quite a bit. How much do you think we've drawn so far? $0. A $1 million revenue company that would be valued at $5 million to $15 million if we were on Shark Tank is drawing $0 for the startup team. So, although there is limitless upside, entrepreneurship is not a game for the weak. So the downside is you may not be able to draw because you're starting a business. All right, strategy number 3, dividends. Dividends are the payments that you get for an investment. So in this, I am including the dividends from stock ownership and dividends from REITs or real estate investment trusts, even the interest payments on bonds that you hold. So all of those I'm including as dividends. I'm excluding one particular thing that will be strategy number 4. So for dividends as I've defined them, the benefit is they are passive. You put money in and you passively get money back. This is the true passive income that you hear about or that you imagine or hear about when you're scrolling on Instagram. So why doesn't everyone use dividends? It's because it costs a lot to get into them. So let's think about a company like Coca-Cola. Their annual dividend is about $1.60 per share. And that is paid out quarterly, so 40 cents every 3 months currently. So if you are going to get enough dividend to earn, say, $1,000 per month, you would need approximately $400,000 invested into a company like Coca-Cola because their shares are about $50 to $55 per share. So if you're getting 40 cents every quarter for a share that you paid $50 to $55 for, you're going to need a lot of money up front. Now, don't let that discourage you. You want dividend income, and you have to start somewhere. So start now investing in companies that are established, that have a great dividend track record, at least 10 to 20 years of paying regular dividend, and you will be able over time to get to that point where you have a substantial amount of your monthly income, or at least quarterly income, coming from dividends. The upside, true passive income. The downside takes time to get there, and you have to have a lot invested in. So strategy number 4 is rental income. So this is the cash flow that you make each month from a property you own and the tenant who's in it. The positives to this, unlike dividends, you can get into the acquisition of property without having to put everything down up front. So you don't have to put the $50 a share up front to get a share. You can take out a mortgage, so you don't need everything up front. The other positive is the potential for cash flow. A $1,500 a month property and mortgage, perhaps in the area you're in, you can rent that out for $1,800 to $2,000 a month. So that cash flow is immediate every single month. The trade-offs, well, I already just mentioned one, the financing. So for a lot of these properties, if you don't already own the property, you're likely going to be financing it. And the amount you pay in interest over a 30-year mortgage is pretty darn close, pretty much 60% of the principal that you asked for in the first place. So you're paying a lot to have that property. So that's a liability. The other downside to this is tenants. I figured out for myself, this is not a game I enjoy playing. So you have to get the tenants, you have to keep the tenants, and you have to respond to the tenants. And those are all things that you have to have the right temperament for. So you can find online numerous resources and books on what it's like to own rental property. I'm not an expert there. I had one property. After about 5 years, I was done with that method or strategy for earning money. But those are the 4 strategies: salary, draw, dividends, and rental income. Use one or all 4 of those strategies or any combination therein to help your family grow wealth by earning income. Awesome.